Welcome to MogulCast, where we uncover the stories behind the world's greatest business empires. Let's get into today's story.
In September 2019, Adam-Neumann sat inside WeWork's headquarters as his $47 startup vaporized in real time. In just 6 short weeks, the company went from being America's most valuable tech unicorn to hovering on the brink of bankruptcy. Wall Street pulled the IPO, investors turned against him, and the board forced him to step down as CEO. The meteoric empire had completely crashed. This is the full story. And it is worse than you think. Long before corporate private jets and tequila-fueled executive meetings, Adam-Neumann was a struggling entrepreneur in New York City. Born in Israel, he served in the Navy before moving to Manhattan, where early ventures like a baby clothing line failed to take off. In 2008, alongside Miguel McKelvey, he launched Green Desk, an eco-friendly co-working space in Brooklyn. We will come back to one specific decision. It is the key to everything. After selling their stake in Green Desk, Neumann and McKelvey took their payout and secured a $15 investment from developer Joel Schreiber for a 33% stake. In 2010, they officially launched WeWork. Neumann wanted to sell more than just office space. He wanted to sell community, culture, and an elevated way of living. Landlords signed long-term leases, while WeWork subleased desks on short-term contracts to freelancers and growing tech startups across Manhattan. By 2015, WeWork was expanding aggressively across major global cities, turning empty urban real estate into vibrant, beer-on-tap workspace hubs. Neumann was named Entrepreneur of the Year as venture capital flooded in. Wall Street bought into his charismatic pitch that WeWork was not a boring real estate company, but a revolutionary physical social network. Tech investors lined up to fund global expansion, driving the company's private valuation into the double-digit billions. The ultimate catalyst arrived when Masayoshi Son, head of SoftBank's Vision Fund, met Neumann for a brief meeting in New York. Impressed by Neumann's audacious vision, SoftBank poured billions into WeWork, eventually driving its private valuation to a staggering $47 billion. By early 2019, Neumann lived like royalty, flying on private jets and expanding into schools and apartment spaces. The expansion seemed unstoppable, but not everyone was celebrating. On paper, WeWork appeared to be disrupting commercial real estate through tech-enabled community spaces. But here is what the media completely got wrong about this. Beneath the sleek aesthetic and free kombucha, WeWork was taking on massive decades-long lease liabilities while collecting month-to-month revenue from volatile tenants. When economic downturns hit or occupancy dropped, those multi-billion-dollar lease obligations remained fixed, exposing a fundamental business structural mismatch that simple startup hype could not mask indefinitely. Neumann maintained total control over the company through special supervoting stock that gave him 10 votes per share. He registered the word "we" under his private holdings and charged WeWork nearly $6 million to license the trademark back. Conflict of interest disclosures mounted as Neumann bought commercial properties personally and leased them back to WeWork. Investors overlooked these warning signs as long as private funding rounds kept pushing the company's paper valuation higher. In August 2019, WeWork filed its public S-1 prospectus with the SEC ahead of its anticipated initial public offering. What Wall Street expected to see was a booming tech pioneer. What they actually read was a financial horror story. The disclosures revealed that WeWork had lost nearly $3 billion over 3 years. Governance red flags, corporate cash burn, and bizarre founder perks were exposed to public market investors for the very first time. Public market analysts immediately tore the filing apart. Unlike private venture funds, Wall Street fund managers refused to value a traditional real estate leasing firm as a high-margin technology company. Within 30 days, WeWork's target valuation plummeted from $47 billion down to under $10. The public offering was abruptly shelved because institutional buyers refused to participate, cutting off the vital cash influx WeWork desperately needed to fund its heavy ongoing operational losses. With cash rapidly running out, SoftBank and the board realized that saving the business required immediate drastic action. On September 26, 2019, under extreme pressure, Adam-Neumann was forced to step down as chief executive officer and relinquish majority voting rights. The meteoric journey from tech visionary to corporate outcast took less than 2 months. And if you have made it this far, you already understand something most analysts completely missed. In the aftermath of Neumann's departure, WeWork's new management had to dismantle the sprawling empire to survive. Thousands of employees lost their jobs, unprofitable lease locations were shut down, and non-core side businesses were sold off at fire sale prices. SoftBank was forced to step in with a multi-billion-dollar bailout package to keep the company afloat, absorbing billions in financial losses on an investment that once defined the era of ultra-cheap capital. The fall of WeWork permanently altered how venture capital operates globally. Investors stopped prioritizing rapid top-line revenue growth at all costs and started demanding sustainable unit economics and clear profitability pathways. Governance structures were rewritten across Silicon Valley to limit founder control and prevent super-voting stock abuses. Neumann's downfall marked the official end of an era where charisma alone could substitute for audited corporate profit and long-term business stability. Remember that decision we mentioned at the start? Here's what it actually cost. Back in 2008, when Neumann transferred early workspace concepts into Green Desk and then launched WeWork on long-term leases, he structured a venture built on unstable leverage. That single operational framework cost investors over $30 billion in lost equity value, caused thousands of worker layoffs, and wiped out the highest-valued private startup in American history within weeks. Figures surrounding Adam-Neumann's tenure remain unprecedented in corporate finance. WeWork raised over $10 billion in funding, growing from one Brooklyn location to hundreds of spaces worldwide. Yet the company lost over $2 billion in a single year, while its valuation collapsed from $47 billion to bankruptcy filings years later. Despite the public fallout, Neumann departed with hundreds of millions in exit stock payouts and consulting settlement deals. The crucial lesson from the Adam-Neumann saga is that narrative power can temporarily outrun balance sheet reality, but market fundamentals always win in the end. Investors focused on charismatic vision while ignoring clear operational risks and unchecked founder governance. When hype dissipates, a business must stand on its underlying cash flows. Relying on continuous venture funding rounds to mask structural operational deficits is never a sustainable business strategy. Adam-Neumann's meteoric rise and fall stands as one of the most remarkable corporate warning stories in modern business history. It serves as a stark reminder of what happens when private market venture hype collides directly with public market accountability. If you want to understand how this pattern repeats across every major business collapse, the next video covers a story with disturbing parallels. That one is next.
That's the story for today on MogulCast. If you found this valuable, subscribe and hit the bell. A new empire story drops every single weekday. See you tomorrow.